I'm Chris Preston.
I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network. Brad, as you can hear by my voice, and everyone can hear that I'm playing a little bit less than 100% today. That's why I sound like Rick James. But Madison definitely got that reference. But I'm gonna try and soldier on. It's been 2 weeks since we've convened, and lots to talk about. How was your Thanksgiving, by the way?
Good. We hosted, so had the parents over. Brother made a surprise appearance, which was nice. I don't
Nice.
know. Nothing super fancy. You traveled, right? You were out of town?
You're in Miami. Stayed at a nice hotel down there for my parents' 50th anniversary. Sort of doubled as celebration of my parents' 50th anniversary. Really nice. Huge pool there. Apparently the second largest pool in the country outside of the Mirage one in Vegas. I've never been to Vegas, but I know that's the thing. Um, and so my kids love that. So they were in the pool constantly. And it was great and warm. And now I'm back in Vermont and everyone's sick. And it is 20 degrees out with a wind chill. It feels like 4. Even by first week in December, even by Vermont standards, that's pretty cold. So yeah, I wish I could go back. But hey,
It,
I'm
see,
glad we're here.
like out here, we can't. I mean, you could use the pool if you were a little bit crazy. It's, probably 40 or 50 degrees, but your kids were in the pool in Miami.
Oh yeah. Yeah.
Is it just like perpetual? I've been to Orlando, never been to Miami. Is it just like
Oh, it
warm
was
enough?
warm.
Did they heat?
It,
Huh.
it was like comfortably warm too. It was mid 70s and up, maybe it got to low 80s. It was nice. Yeah, it was great. Played some golf. Um, just not having to just brace yourself before walking out the door was good enough for me. But yeah, I got some swimming in too, and yeah, it's great.
That sounds like a nice trip.
It was. Okay, so let's talk about everything we missed during those couple weeks. Um, Brad, tell us what's on the docket today.
Yeah, so today we are gonna do sort of a starting five instead of a big three, just to cover a lot of ground. Sentiment measures are ticking up. Is the market getting overcooked? Bitcoin broke 100,000 for the first time ever. Worth talking about. Where could it maybe go from here? Does that change our perspective on it? Probably not. Healthcare has been the major laggard this year. It's the only S&P sector that is down in 2024, I believe, but we will get some clarity on that when we get into it. Bond yields, mortgage rates are both ticking back down again. And then we are also going to talk about holiday shopping, retail, and whether there is maybe an opportunity that we're all overlooking out there.
Yeah, but first, as always, we have our defend the take, and Brad, thankfully, you're up today. So your take, for which you have 90 seconds to defend, is simply that silver will outperform gold in 2025. Go for it.
All right. So I had called that gold had sort of topped out at the end of the year. It seemed like some structural issues were gonna pull the price performance down a little bit, and that seems to sort of be playing out. Um, I don't necessarily think that gold is not going to have a good year next year. I think macro stuff is going to really come into play there. But I do think that silver has a pretty interesting catalyst right now and going into next year. Um, China just recently stopped or passed a proclamation banning the sale of certain rare earth minerals to the U.S. Things like antimony. There's a handful of others there. China has also been buying a ton of silver. Earlier this year, they were paying up to a 10% premium over spot prices to acquire silver. It's used for EV batteries, solar cells. There's a ton of industrial uses for it. Um, that level of buying, and they are about a 10% producer of silver as far as their percentage of the global share. They've been buying silver from unrefined silver ore from, I believe, Africa. So they are acquiring silver sort of wherever they can get it. not quite trying to corner the market, but it's pretty close. Assuming that their economy holds up or that they have a push towards more and more production as the solution for their sort of ongoing economic woes, especially if it's green energy transition stuff that they may be able to export to the rest of the world, global south, Latin America, et cetera. I think that that makes a compelling case that they might be trying to corner the market a little bit on silver. And that is going to be a big contributor to the price performance next year, which should, in my estimation, allow it to outperform on a percentage basis gold.
Okay. I'll let you go. About 15 seconds past, but that's
Ah,
okay. Yeah, good. Sounds like a good thesis. I mean, I definitely think, gold has been the headliner among the metals, obviously, in its rise. And just historically, there's only so much higher gold can go, you would think, despite its safe haven status. Silver, isn't really, it doesn't get, at least doesn't get the credit for being a safe haven, even if it, in practical terms is sometimes. Um, but, the catalysts you described all sound, um, pretty viable.
well, silver has also outperformed in the last 5 years compared to
Yeah,
gold. It's up, I think, 82% versus gold, which is up in the 70s. I know Citi analysts like silver to outperform as well. Um, the part of that sort of hinges on continued economic strength and not something like a global recession, right? Like there's so many factors that come into it, especially with silver, which is more of a production metal than a safe haven hoarding kind of metal. But
yeah.
if, and I think we'll get into it when we start talking about some of the other things in our starting five, but if the economy ends up being stronger than I think a lot of people are afraid, um, I think there's room for outperformance there. And I mean, we'll see, but I like it better going into next year.
Do you think silver will outperform gold and the market or just gold?
I would say just gold.
Yeah, I
Um,
was going to say my instinct is the metals will be not necessarily down next year, but I don't. I'd be surprised if they have the type of outperformance they've had the last year or two.
yeah, if the market holds up and is really driving higher, like I know upside price targets are probably around 6,500, 7,000, right? We're closer to that 10 to 15% range.
Yeah,
Still a lot of cash on the sideline. If interest rates are coming down, there's nothing other than macro stuff that really gets in the way of the market outperforming for a third year in a row. I mean,
right.
I know it probably sounds weird coming from me,
Yeah,
these perpetual bear, but I don't see anything that prevents another, 15, 20% year on the S&P if everybody is surprised by the economic strength and the soft landing hits and tariffs are a lot of bark and no bite. Or like if things sort out well, um, I think we've got room to surprise to the upside.
this should have been your take.
Oh,
It's
yeah.
15 to 20% coming from you would have been surprising. But yeah, it leads right into our market discussion. Is the market overcooked? There's some indicators that suggest yes. The bull bear ratio, which internally the company at our company, Michael Brush, who we've had on here before, does a good job. Our analyst Slack channel saying here's where it is. It's and anything basically any reading above 4 is a red flag, and right now it's at 3.91, so not quite there, but getting a little frothy. Um, Another popularly used one is the AAII investor sentiment survey, which right now shows 48.3% bullish versus 30.7% bearish, 21% neutral. The historical average is 37.5% bullish. So it's, a solid almost 11% higher than usual. Although interestingly, the bear ratio now around 31% is the same as the historical average. Um, Insiders are more bearish than they've been in a decade, apparently. I mean, this is 2 straight years of more than 20% gains in the S&P. Now as we've discussed, up until what maybe the back half of this year, pretty thin rally. There's all that cash sitting on the sidelines that you mentioned that I think is starting to get deployed. Um, what do you see too many red flags or even yellow ones out there right now? I mean, clearly you just said 15 to 20% next year, and I think I might be more conservative than you on this one. I think maybe might be more of a 10% year next year, but I also
So,
said that about this year, so I was wrong.
well, that's the thing. I came into this recording this conversation like fully intending to be like, all right, well, maybe we're a little bit overcooked. The sentiment readings are really high. The last time the bull bear ratio was up over 4, the investors intelligence ratio,
Mhm.
um, earlier this year. The time before that, end of last year. In the last year, S&P's up 33.8%.
Hmm.
So you can only take so much away from the sentiment measures.
Right.
Um, Part of it is like political, right? Like there was an interesting graph that was making the rounds that showed that, you know, Democrats' assessment of the economy was super high before the election and Republicans was super low. Uh, Flip side is post-election, Republicans think the economy is doing great, Democrats think it's doing poorly.
Hmm.
That kind of disconnect in economic perception, I think would make itself most evident the in the investor sentiment measures. I do think that it's sort of dislocated from the actual
Yeah.
economy. The wild card is new policies next year. If we have 500,000 people laid off from the federal government, if we have 20% tariffs across the board and they come in hard and they come in fast and there's no exceptions, right? Like there's plenty of stuff that are sort of unilateral economic decisions that could throw up some roadblocks for the market.
Hmm.
Uh, but assuming some of those worst case scenarios are reined in or throttled, we do seem to be the only first world economy that it has post COVID really not had to deal with a recession or a massive slowdown. I mean, like we've talked before, the K-shaped recovery and how that's been uneven for people. But the fact of the matter is things are going pretty well. Productivity is up actually in the US in the last couple of years, which really is a standout for us. And that's, I think, something that Tyler was talking about earlier this year is that productivity growth could be like the big driver. Um, so assuming we get business as usual or business as we've had for the last couple of years, we're humming on all cylinders economically. It doesn't always feel like it, but the feeling part sort of gets in the way of the statistics. I do think that there's more room to run, but the caveat when the last bear gives throws in the towel, like that's when you sell, right? So maybe we're there,
Yeah.
but we're
Yeah. Yeah, it does seem like you look more like a bull now than a bear than you did before Thanksgiving. Yeah. Yeah, more bullish. Yeah, like the goatee-ish kind of thing there. Um Here's a question for you. So one just sort of stat I wanted to drop, whether this matters too much or not. The last time there were consecutive years in the S&P of 20% gains or more was the late 90s. They're actually, I believe there are 4 straight years. This is the dot com. These are the roaring dot com pre-bubble bursting days, 96 through 98, up 20% every year, 99, 19.5%. So effectively one, two, three, four, 4 straight years. Um, no, I'm sorry, 5 straight years. Um, and then, we know what happened after that. It, it doesn't really mean anything necessarily, other than maybe from a perception standpoint. I guess here's my question for you. Do you think, because two things can be true at the same time, Do you think that we could have a, you know, 15-20% up year, and yet the next bear market could start by the end of next year? Because that's always measured by the top. It's measured by the top to, 20% down from there. What do you think?
Yeah, yeah. Like, we could run up 15% by March, and that is when tariffs bite, or when that's when some new policy hits, or
Hmm.
that's when some black swanny thing kind of comes in. Um, One of the things that, you know, if you look at like the CAPE PE ratio, if you look at the Buffett indicator, those all are sort of markers of a very overvalued market. Um, One of the things that I do wonder if, like, I hate to say it because these are the worst four words in trading, but that maybe this time it's different.
Hmm.
The number of public, I'm looking at a graph from St. Louis Fed right now. Number of listed companies in the U.S. per million people was what I was able to pull up as we were talking. That peaked in 1995 at like 30 listed companies per million people. So that would have been 10,000 publicly listed companies. That number's been cut down by a third.
Hmm.
It's down to 12 and a half. So you're closer to about 4,000 listed companies in the US. And the reason I bring this up is because we've been talking about how top heavy the market is for almost a year and a half, 2 years now, right? With
Yep.
your Mag 7, the Nvidias. Um,
Hmm.
there is just less of an arena for the public and for companies that invest in publicly traded companies to put money. It is There is just a smaller pool of possible investments. So we may be seeing an effect in which money that, say, 25 or 30 years ago would have been more diversified across a much larger pool of investments is now, because of the lack of available publicly traded companies, forced to chase. You're forced to allocate more into fewer companies because the money has to go somewhere. The Vanguard Total Stock Market Index, VTI, just sent out a revision to their prospectus warning that because of how heavy Nvidia and Apple and Microsoft are, that they can no longer say that the fund is technically diversified. Um, we may just be seeing a sort of systemic side effect of there being fewer companies to invest in, the increase in number of people that are investing through ETFs, mutual funds via 401ks. I'm not saying that it's necessarily a change to how investing happens, but it may be a symptom of the investing system that's in place right now and less of a marker of a super overheated market. I do think the market is hot and probably could use a breather, but
Yeah.
if we get a 10% pullback or a 5% pullback and then we just resume the bull market, I wouldn't be stunned by that, certainly.
No, I can see that happening. Especially once we hit the new year. Uh, once we get past, holiday fervor, that kind of stuff. Um, and we saw it second half of July into August, the first week of August, that was what, 8% pullback in the S&P, 13-14% in the NASDAQ. And that totally changed perceptions. People were like, ugh, when is this market ever gonna get going? Um, and since then, I mean, sort of to your point about, the market sort of the rally spreading finally to, beyond the Mag 7 and a handful of stocks. Most of the gains, the S&P equal weight index is up 17% year to date. Most of those gains, not all, but almost all of the gains have come since the August bottom. So
Yeah.
it's almost like in some ways that the real rally has only been going on for 4 months. So yeah, doesn't feel like the bull market is on borrowed time just yet, but it does feel like we're due for a pullback. And I think we will get one the next couple months, probably. How deep the pullback is, I don't know, but we'll see. I wanted to mention this is just another sort of market. If you're making the argument for market overheated, Bitcoin dipped its or poked its head above 100,000 for the first time ever. We love round numbers, so I don't know how much that means. It was already pretty high, above 90,000. It's pulled back a bit today, but we've said over and over we're not Bitcoin investors. It could be short. We like it as a short term play in bull markets. I certainly don't like it at these levels. Um, but I think if the market's going to pull back, I could see Bitcoin being, a sharp pullback from 100,000 could be one of the first signs of,
Yeah.
of some at least short term weakness in the market.
Yeah. Yeah, I think that makes a lot of sense. It is sort of a risk extension of the market,
Right.
where it's like, hey, the market's doing great. Where else can I chase even higher returns? And then sort of Bitcoin is right there. It hit as high as I think 103,000 a share.
Hmm.
Uh, Jerome Powell at a New York Times deal book event, I believe, came out and said, "Hey, Bitcoin's digital gold." Not so much. He said he doesn't see it as a threat to the dollar. He sees it more as a threat to gold.
Yeah.
Um, the 100,000 level is like for the Bitcoiners is a pretty big psychological level. It makes sense. You add a zero to it, right?
Right.
Um, the I am not like doing a portfolio allocation to Bitcoin at this price at 100,000. I think if we get a market pullback, it probably pulls back into the 70s where it was sort of capped to the upside earlier.
Yep.
What I think I like more right now, if you're buying Bitcoin or if you're looking to speculate on Bitcoin, I should say, is is not buy it at 100,000 and hope it goes up to 140. It's look at look at like option contracts on some of the ETFs like the IBIT or something like that at like 180 with the assumption that if it's running, it's going to run really high. And if
Hmm.
it doesn't run high enough to get there, you're out very little. Um, so I would be just given the nature of how Bitcoin trades, there are models that some people like to look at that have varying degrees of success that point to Bitcoin at 295 or 360 by the end of the first quarter of next year. I'm actually, going to write a post about it that'll go out on Monday, but that's sort of the nature of the beast. And if the market is stronger than people are afraid it is, it doesn't take a ton of action to get something that, the motto for the Bitcoiners is hodl, right? It's you just hold on to it. You hold it and you let it run. That takes a lot of gas out of the sellers in a strong bull market. So I don't necessarily like it at 100, but if you like it at 100, I like it more at like 150 and then going to 200. Um,
Right.
so I mean, you have to sort of engineer a trade based on option, like out of the money bull call spread or just deep out of the money calls or something like that is probably my preferred way to play it. But um, yeah, it still doesn't do anything. You still can't buy anything with it.
Yeah. I as I sort of said on here, I was banging the drum for Bitcoin back when it was, I guess it was mid last year when it was in the high 20s, and it really taken a beating. I love it at the beginning of a bull market, of a new bull
Yeah,
market, um, or even off of a big pullback. Like, early August probably would have been a good time to buy it, because the bull market wasn't over, but it had been stocks and Bitcoin even more so had been beaten up. But yeah, I just 100K, psychological or not, I can't. The fact of the matter is, it's all-time highs, or at least it was until the last couple of days. I can't get on board with Bitcoin at these levels. Okay, number three, healthcare stocks. I could use one right now. In tree, I wrote in my Cabot Value Investor issue this week. I added a healthcare stock. I won't say its name, based on the fact that you know, every sector in the month since the election is up, and most up big, except for healthcare stocks. Not down much, down like 0.5%. And for the year, it's the worst performing sector, up like a couple percent, 2, 3%, something like that. Um, the last month or last few weeks, the reason it's been knocked back because of Trump's RFK Jr. nomination, which, regardless of how you feel about that, is a controversial pick given his, anti-vaccination stance and certain other, um, you know, uh, misinformation, or at least perceived misinformation that he's given out. Regardless how you feel about that, the market didn't like it, but seems like things are bouncing back now. Um, and what that did, that little mini sell-off, created even more of an opportunity in a sector that's already underperforming. The fact of the matter is, and Tom Hutchinson, who we've had on here and is our um, chief analyst of our Cabot Dividend Investor and Cabot Income Advisor newsletters, he has several healthcare sectors based on the premise, and there's no refuting it, the aging of the population. Baby boomers are, well, now the second largest generation, but it reached the age where they require more health care. And, you know, people are always going to need more health care, especially in, regardless of whether the economy is good or not. That doesn't change. So I like trying to play the by far the weakest sector, um, and especially when it's one that's sort of an all-weather sector like healthcare stocks. What do you think?
It's tough, right? I mean, we're the only first world economy with publicly traded healthcare companies, right? Like, there's not a lot of comps that you can use out there.
Mhm.
Um, if there's more of a push to rely on private sector for providing healthcare and we don't change how it's delivered or how people are insured, it's like, yeah, there's a lot of profit opportunity there.
Yeah.
Um, I mean, like, especially long-term care as a sort of subsector of that seems like a spot that's sort of ripe for outperformance. There's a lot of conversation around like the great wealth transfer, how all these boomers, I say boomers, but how everybody in the silent generation, the baby boomer generation, how they've got something in the neighborhood of like $90 trillion that's expected to be passed down to their heirs over the next 10 to 20 years. I think there's a compelling argument that a lot of that will actually get sort of eaten up by healthcare providers, by long-term care providers, right? Like, I won't, I don't know, speak to the morality of it, but like, if you are looking to be where the money is and will probably continue to be there. But there's also I mean, there's the sort of new administration of it all, right? Like, who knows what RFK as the head of Health and Human Services pushes to do. Who knows what policies might look like? I don't know. I think healthcare ultimately is probably a stay away for me. Um, there's just there's too many for me at least. There's too many sort of feasible outcomes for it, um, and and there's too much. It's too reliant on politicians. It's one thing for me to try and make an economic case for some of these things and say, okay, well, the economics of it will ultimately override whatever the political will is or whatever kind of pushback there is. But with this one, it just goes so hand in hand with politics that I can't I can't really make a great case in either direction, and that's enough to probably have me staying away.
Yeah, I mean, well, this is great that we're disagreeing. It's better podcasting, frankly. Yeah, while I don't disagree with you about, politicians influencing healthcare, policies and by proxy stocks in the short term, healthcare is a necessity that is not, in terms of long-term investment, it's not going away. Now, which companies to invest in, that can be debated, but I think by and large, I like the upside versus the risks in this case, where there's not much that's undervalued in the market right now, and healthcare stocks
Yeah.
definitely don't. So from a value perspective, I like healthcare, um, at least at these levels. Okay, let's move on to number four in our starting five. Bond yields have finally been falling. It's not plummeting, but the 10-year Treasury yield has dropped. Let's see, it was from as high as about the mid fours in mid-November. Let's see, 4.45, now
Yeah.
down to 4.1817, excuse me. Mortgage rates have fallen a little bit, but still above 6%. But they're back down to what they were a few months ago when the Fed started cutting interest rates. Um, what does it mean? Um, why are they falling now? I guess we've sort of said like the cumulative effects of the Fed cutting rates every time they cut rates that should um, those should begin to accumulate and pile up and result in lower mortgage rates, you know, lower yields on 10-year note, lower bond yields in general. Um, do you think how much lower do you think they can go, I guess, in the coming months? Fed's widely expected to cut rates by another 25 basis points later this month. But it seems like it might be a little bit slower pace than expected next year. Someone mentioned the possibility of doing it every other month next year, or every other meeting, I should say. We'll see how much. I guess where do you see rates going from here? I guess a year from now, where would you expect them to be?
I think the Fed had the terminal rate for 2025 in their summary of economic projections in the mid threes,
Mhm.
and that feels about right, somewhere in the three and a quarter, 3.5 range. I know the mortgage industry is of the opinion that over the next 2 years, mortgage rates will come down and probably settle above five. I think that industry is widely expecting that the 2%, 3%, 4%, even probably 4% rates that we saw in the past were sort of a one-time pandemic thing, and that rates are gonna hold higher. Um, I think that pretty closely mirrors my expectations that I don't think we get below three next year.
Yeah,
Something around 3.5, especially if the economy holds up, if the market stays hot, they're not going to be necessarily in a huge rush to cut rates. And we've seen the stock market sort of diversify out performance wise into smaller caps. If if productivity is improving, that offsets a lot of the pain that smaller companies would feel from higher borrowing costs. So if we're just business as usual and we're continuing to exceed sort of what global economic productivity has been and what we've seen lately, I don't know. I think, you know, low mid threes to high threes for the 10-year at the end of next year, and then
yeah,
low to mid threes for the Fed funds rate, and then mortgage rates in the high fives. That
yeah,
feels about right to
yeah.
me at the end
Maybe
of the
mid,
year.
maybe mid fives at best. But yeah, I agree. And the latest data point, today's jobs numbers out were better than expected. It was 220,000, 225,000 jobs added.
I thought it was 247, but I could be wrong about that. The the thing
Employee.
that stood out to me while you look at that is they revised the October number upward. Uh, they'd come out with 12,000 jobs added. They revised
Yes.
it upward to
Yeah.
36,000.
Yes.
That was big. They have been revising that number down like
Hmm.
every month sequentially for like the last year. It's been, hey, no, the numbers were not as good as we thought. Um, they revised that up for the first time in a while, and It's not
You would think
huge.
12,000 would be the one time that they would revise it up. Now, granted, there are reasons behind the October number being low with the hurricanes, and the was it port strike that month too, I think.
Boeing had layoffs. I saw that was
All
getting
layoffs.
that
Yep.
was something they blamed it for. But the port strikes resolved really quickly, or at least got pushed out to January.
Yeah, true.
Um,
Um, yeah, I guess the Boeing layoffs were one of the big ones cited. Um, but yeah, I have the number. The new jobs added were 227,000
okay.
in November. 220 was the expectation. So not that much higher, but unemployment rate did tick up from 4.1% to 4.2%. Um, but you're right. I think the revision upward in October is probably the biggest positive from today's jobs report. Um, I think it all goes toward, economy is still it's been pretty resilient. It's still doing okay. Inflation, while there's been a few troubling signs out there, like egg prices and milk prices have gone up more than usual lately. Um, I think, that we're still in a pretty good sweet spot. The Fed has sort of landed us in a pretty good sweet spot. And while I don't think their cutting campaign is going to be as aggressive as initially thought, I think it'll be, steady cuts through next year, and that'll be, I think it'll get us to the levels you talked about. And I think that'll be good for things like home builder stocks and, um, a lot of things retail related. Okay, let's move on.
Yeah, one last thing on the home builder front.
Or sorry,
You know,
real estate. Sorry, that's what I meant.
but
Sorry, go
yeah,
ahead.
yeah, real estate wise, that market really picked up just from rates getting back into the 6% range. And I know that there were surveys done that found that like the 5% range is sort of the sweet spot. So I do think that if that Fed regular rate cut cadence uh, is there and the 10-year Treasury yields are coming down and then mortgage rates commensurately are coming down as well,
Yep.
I do like that sector. Again, just if we're business as usual, if we keep exceeding expectations, um, and assuming there's no labor disruption, which is a big risk for home builders, I do like that sector a lot. I think there's a lot of room to grow, especially for the new home builders.
Is my lighting off or do I look grayer than usual? I
Well,
don't
I
know.
just assumed you were on death's door, so
Yeah, I know. Yeah, the man cold is similar to death's door. Okay, last but not least, uh retail. We're coming off of Black Friday, big Thanksgiving week, Cyber Monday, holiday shopping season underway, and it was a good start to the season. There were 197 million consumers through the 5-day weekend, is according to the National Retail Federation. The forecast was for 183 million consumers, so above expectations. 197 million shoppers is 75% of the U.S. adult population. Um, so that signals good economy. So with that in mind, any retailers, just we figure I'd do this anecdotally. Any retailers that you are sort of go-tos for you this time of year? I guess publicly traded retailers, preferably.
so my anecdotal experience was actually I got a second one. I'll bring that up, but my was mostly Amazon, Lululemon for some stuff,
Mhm.
but not a ton. Um, and then the one that I wish was publicly traded, but is not, is Hot Topic. I have no idea. I've spent hundreds and hundreds, or my wife and I have spent hundreds and hundreds of dollars at Hot Topic, which
What
I
is
think
that?
it's a teens and early 20s adults. So it's got like Funko Pop figures and t-shirts, and it's like it's like a PG rated Spencer's Gifts. Did you have
Hmm.
Spencer's when you were younger?
Yeah.
Okay.
Yeah.
So yeah, so like blacklight stuff and but like t-shirts and anime and a lot of character stuff. Kids love stuff from there. I wish they were publicly traded. They're not. The other one that is publicly traded, but I would not recommend, Macy's. We did the Salvation, my daughter and I went to the mall. We did the Salvation Army Angel Tree at Macy's, and shopping at Macy's now feels like shopping at Kmart used to, which
Hmm.
is not a great retail experience. So uh puts
No.
on puts on Macy's. I'm bearish on Macy's after that experience. But like it's Amazon, right?
Yeah. It's Amazon, Amazon, Target. We do a lot of our, especially for our kids, with our kids. There's a Target nearby. We do a lot of our shopping there, or holidays or otherwise. Our go-tos around the holidays are very Vermonty, local. We try and shop local, Brad. It contributes to the local economy. I don't think Jamie Two Coats, the toy store, 10 minutes from us, has is publicly traded, nor the clothing store, women's clothing store, Misa, which is nearby. Basically get anything from, not anything. Anytime I buy gifts for my wife, it's usually there, or a lot of times. But so we wanted to bring in Madison Robertson, our producer, to ask you to just get another perspective in here. What are some of your go-tos around the holidays?
Um, okay, for decorations, Hobby Lobby. I'm a big fan of Hobby Lobby. Um, Walmart actually had a lot of good decorations this year, which I'm not a huge Walmart person, but I've been impressed by them lately. For gifts, Amazon is in there. But Etsy was a big one for me this year. I really, especially now that we have a baby and I have to get grandparent gifts. Like I think I got her face on a coffee mug, a car air freshener, some socks, like her face
Nice.
on a whole bunch of things. So
Brad and I will expect ours in the mail pretty soon.
it's
I assume.
Christmas. You have 19 days.
That's true.
You'll get
Yeah.
it in 19
You have
days.
19 minutes. Yeah. Okay. Yeah, Etsy. That's not one
That
that I thought much, but here, let me look at Etsy chart.
Yeah, that's an interesting one. We had taught like looking at sort of semi-alternative retailers, so far this year down 28.9%, but in the last month they're up 8.5%.
Hmm.
I, market cap of 6.48 billion, traded 30 times earnings. They're trading at levels that they traded in the early 2020s, like not quite post-pandemic, but like pre-pandemic.
Yeah.
I I don't know enough about Etsy to say, hey, that's a great value price, but if you're looking for maybe like an overlooked uh stock, that might be a good one to add to your watch list just to keep tabs on, especially if producer Madison is representative of the younger generation, which I don't know because I'm old.
I'm
Yeah.
like half old, so I can like sort of
Well,
represent.
you're in the largest generation now. You're a millennial, right? I
Um,
think.
I
Uh,
am.
Hey, you're a millennial, Chris.
no, just
I,
miss. You might be a millennial.
no, I think you're technically a millennial. Well, you're what, 42?
Keep going.
43?
Oh no,
I
this is
was until a couple months
embarrassing.
ago.
Oh
44.
yeah. All right.
I'm
Yeah, my
80. So I miss. I think
you
80,
do miss.
82? 82?
81. It's weird
Or it's
though.
moving target. Yeah.
Like we're the echo boomers, right? The age cohort that grew up that information technology grew up with us. So we're not quite Gen X, we're not quite millennials. Like I'm 83, my wife's 82, so we're elder millennials, which I
Yeah.
feel I
I've
feel
always
the elder
considered
part of that.
myself Gen X, proudly.
Yeah.
But
It's stolen valor a little bit.
yeah,
Stolen Gen X valor.
yeah, 80. I'm in there, and my wife is too.
Mads was born in the late 90s.
92. My
Oh,
husband's
okay.
96.
Man,
Wait, 96?
for
Yeah,
her husband.
I robbed that cradle. You know what I mean?
Oh, he was 96. Okay, I see.
Yeah.
Um, wow, 92. Okay.
So,
Mhm.
Yeah,
You were
but
10. Oh, wait,
I
you were
was
12.
12. Yeah, thanks.
But in all seriousness, if Madison is representative of a younger shopping cohort that says, "Hey, we don't really
Yeah,
want a bunch of plastic stuff from China. We want handcrafted gifts that are maybe more meaningful that we can source more locally or domestically," maybe that makes a case for Etsy.
yeah.
I don't know.
It peaked 3 years ago. Late November of 2021, peaked at 294 a share. It is now at 57 a share. And like you said, it's up, about 9% in the last month. Could be a good value pick there. Might have stumbled onto something.
Just call me a stock analyst.
Yeah. So if you buy that stock, some of the profits need to go to Madison, I
I
think.
agree.
She needs them, to buy all these mugs for us, with her
Honestly,
child.
it's really the most dummy-proof shopping. Like if you're not that, I don't even creative or whatever, you don't want to put too much thought into a gift. Like I had a friend of mine, a best friend from Florida, lost her cat last week. I went to Etsy and I typed in cat loss gifts, and like 1,000 things popped up and found this bracelet. And they like put a picture of the cat inside the bracelet somehow. Like it's like they have something for everything and everybody, and it's just dummy proof. I love that. I love Etsy a
Right.
lot.
That's it. We're officially recommending Etsy. I think that's it. That's our value pick for 2025. You on board with that, Brad?
Yeah, yeah, I'm on board with Etsy. I
Okay.
liked I liked eBay earlier this year. I don't think they've been doing super great lately, but similar sort of you know, not exactly a major retailer
Right.
online for oh no, eBay's up 45% this year. All right, it's
Oh,
doing all right.
nice.
Um, but like obviously it's different, but it's sort of a one-off retailer and not a massive volume retailer like your Targets or your Walmarts.
Right. Okay. Well, Etsy's a good place to close the show with an idea, outside the box idea, not that didn't come from either you or me.
Yeah,
So
if Etsy does really well next year, I think we have to give Madison like an immunity idol or something that she can use. Where like if she comes onto the show and beats us at picking stocks or
yeah,
identifying things, then she has to have there has to be like a coupon or something that's like get out of a
yeah,
recording an episode free or something like
there
that.
you go. That's a good
Maybe just
idea.
buy me gifts off Etsy.
Yeah,
Oh,
maybe
yeah,
that's it.
Just
better idea.
buy me stuff.
Flip side, if Etsy's underperforms, you know who's joining us for a hot sauce
And
episode.
that's too bad
Yes.
for you all, because I'm not a stock analyst.
Yeah, it'll just make us look better, I guess. But maybe not. We're the ones who are saying, yeah, buy Etsy.
The bar is
Okay.
pretty low if I'm contributing to stock
Yeah.
picks.
No,
And
I have
that makes
confidence.
you look better.
I have confidence in it. I think it'll do well. I
Okay,
like the
good.
value. Okay. Well, thanks everyone for joining us this week. Thank you for bearing with me. I'm gonna go have some soup and a nap. Brad, any last words?
Happy
Bye,
holidays,
bye,
everybody.
Etsy. Bye,
Bye,
Etsy.
bye, Etsy.
All right, and we will be back hopefully 100% next week with the latest episode of Street Check. We'll talk to you then.